Welcome to the Economics of Me podcast. This is the 5th episode of the Economics of Me podcast, your place for making sense of the economics of everyday life. Born out of my own learning, our mission is to simplify concepts, economics, and business, bringing it all back to first principles and what it means to you. And as we're telling stories, I'd like to acknowledge the traditional custodians of this land, the Wangal people of the Darug Nation, on which I'm recording this podcast. The Wangal people have been telling stories for over a millennia, and I'm committed to treading lightly on these lands as we move forward to a future of reconciliation. Today, we're talking about something you hear about all the time: stocks. Whether you're scrolling through the news, hearing about Wall Street, or overhearing a conversation at a cafe, stocks are everywhere. In our previous episode, we talked about mortgages, but given the broader challenges in the housing market and the cost of living crisis that we all feel, saving a deposit here is quite the pursuit. The barriers to entry are quite high. This brings us to stocks, and while this episode is not financial advice, you can now pick up your phone, download an app, and invest as little as 50 cents into a stock of your choice. What are they, and why is it so important to understand them? We'll look into their origin story, and you'll see how owning stocks allows you to be a bit part of a business and the wider economy, fueling both growth and change. Today, on the 5th episode of the Economics of Me podcast, we explore the economics of stocks. For us to deep dive into stocks, it's worthwhile understanding their origin story. And to do so, we need to talk about colonialism. Why is this? Well, you see, the origin of stocks is deeply tied to the age of European colonialism, particularly during the 1600s, when empires like the Dutch and British sought to expand their global reach. To begin, let's imagine the 1600s, a time of exploration and expansion of European power to the New World. Picture this: the world is opening up through trade. Countries like England, Spain, Netherlands are sending their ships to far-off places to bring back spices, silk, and other valuable goods. Really peak colonialism. The creation of stocks, or shares in a company, emerged from this need to fund highly risky sea voyages to far-off colonies in Asia, Africa, and the Americas. It essentially financed the exploration, conquest, and exploitation of new territories without relying solely on royal treasuries and spreading the risk and reward among wealthy merchants and individual investors. See, sending ships halfway across the world wasn't exactly cheap. It's dangerous, and most importantly, it was really, really expensive. And this is where the idea of stocks was born. A group of Dutch merchants came up with a solution. Instead of one person or one family footing the bill for these risky voyages, why not share the cost? They created a company where multiple people could invest money, each of them buying a share of the company. If the voyage succeeded and the ships came back loaded with goods, everyone who invested would share the profits. But if the ship sank in a storm or got attacked by pirates, everyone shared the loss. And this way, the risk and the potential reward was spread out. And here, the first modern stock market was born in Amsterdam in 1602. The company that really kick-started this concept was the Dutch East India Company, or as the locals called it, VOC. And it wasn't just a small operation either. This was the company of its time, responsible for exploring new trade routes and setting up massive global trade networks. What made it different was that for the first time, regular people, not just kings or nobles, could buy shares in the company. They could literally own a piece of it and profit from its success. But it didn't stop there, and more people wanted to buy or sell their shares. Something interesting happened. A marketplace for stocks emerged, and this was the world's first stock exchange, the Amsterdam Stock Exchange. In there, basically, investors could buy or sell their shares in the VOC, and eventually, other companies got in on the action too. And soon, stocks became a way for companies to raise money, not just for voyages, but for all sorts of business ventures. And here's why that matters. This system allowed businesses to grow in ways that they would have been impossible before. By selling shares, companies could raise large amounts of capital without borrowing money from banks or wealthy families. And this fueled innovation, from shipbuilding to railroads to factories. The concept spread across Europe, eventually making its way to London, where the London Stock Exchange was founded in 1698. And then, a little later, it jumped across the ocean to the United States, where the New York Stock Exchange was established in 1792. So again, this economic progress is rooted in colonialism, establishing trade routes, and also exploration. It's important to understand this origin story because often the growth of something can be at the expense of another thing. And in this case, it was the countries that were colonized. This is an important historical frame to understand this, and perhaps it's a podcast for another time. But the small silver lining here is the democratization and access to business that everyday people gained when it was previously only in the realm of the rich and royalty. I don't want to discount this history, but what about now? What about stocks and their place in our financial future? Let's get back again to first principles. Firstly, what is a stock? Imagine this. You walk into your favorite cafe. Now, let's say instead of just ordering a coffee, the owner gives you a really unique offer. They say, "How would you like a tiny piece of this shop?" Suddenly, you're not just a customer anymore, but you're a part owner and you have equity. This is basically what a stock is. When you buy a stock, you're buying a small ownership stake in a company, whether it's Starbucks, Disney, or even like a huge company like Apple. Owning a stock means that you have a claim to a part of the company's assets and their profits. So if the company does really well, say it creates a really great new product like the new iPhone 16, or in the case of Tesla, a new car, or they finally get to their full self-driving software, the value of your little slice can go up. On the flip side, if the company struggles, the value of that stock can drop. Stocks are kind of like a vote of confidence in a company's future. So why does any of this matter? Well, stocks are a huge part of the modern economy. They affect not just big investors and Wall Street types, but really everyone. Here's the deal. When companies want to grow, they don't always have the money sitting in the bank to fund their big plans. And so they sell stocks to raise money. That's why so many companies decide to go public. It's a way to get the funds that they need to expand, hire more people, and develop new products. Now, here's why it's important to understand stocks. Whether or not you invest, stock prices influence a lot. So every working Aussie has a super fund, right? Chances are that some of that money is tied up in the stock market. And so when stocks do well, your future savings could grow. And when they don't do well, you'll probably feel it too. Even the prices you pay at the grocery store or the interest rate on your mortgage can also be influenced by the stock market because it impacts the overall economy. So over the last 15 to 20 years, this democratization of stocks has been a big shift in how people like us think about investing. You no longer need to call up your broker, get them to quote you a price, and then ask them to put an order for 50 shares of Telstra in. Nowadays, the power to invest is available on a device near you, allowing everyone to own their slice of the pie. But as we become a bit owner of a company and a bit player in the stock market, we need to understand our place in it all. What's a stock exchange and how does it work? Let's explore. So let's start with the basics. What is a stock exchange? Imagine a huge marketplace, but instead of people selling fruits and vegetables, they're buying and selling pieces of companies. The stock exchange is essentially a meeting place for buyers and sellers to trade these shares. Whether it's Apple or Tesla or the local cafe that we talked about, companies list their stock on an exchange so people like you and me can invest in them. Now, when people talk about the stock exchange, they're usually referring to a big, famous one, like the New York Stock Exchange, the Nasdaq, or the ASX in Australia. These are physical places, or in the Nasdaq's case, a digital one, where the majority of trading happens. Picture a bustling trading floor, people shouting prices, computer screens flashing numbers. That's the old school image of stock trading. And while a lot of it is now done electronically, the core idea is still the same. Stock exchanges are where buyers and sellers meet to do business. So how does this all work? Let's break it down. Say you want to buy a share of a company, and let's go with Nike for this example. First, you'll need a broker, which is like a middleman between you and the exchange. And thanks to technology, you don't have to physically call anyone anymore. You can just get an app or a website like, say, Stake or Sharesies in Australia, not sponsored or affiliated in any way with this podcast. And then these platforms connect you to the stock exchange. Once you're on the platform, you search for Nike's ticker symbol, and in this case, it's NKE. You decide that you want to buy a share. And here's the interesting part. You're not just buying from the company directly. Instead, you're buying from someone else who already owns that stock and is willing to sell it to you. This is the key. Stock exchanges are like matchmaking services, bringing buyers and sellers together. The exchange itself doesn't own the stocks. It just facilitates the trade. So when you place an order, you've got a couple of options. And one of the most common is called a market order. And this means you're telling your broker, get me that stock at whatever the current price is. If the current price for Nike is $100 per share, your order will go through around that price. It's quick and easy, but prices can fluctuate from the moment you place the order and when it's filled. Then there's the limit order. And this is where you get to say, I'll buy that stock, but only if it hits a certain price. So for example, you might set a limit to buy Nike at $95 instead of $100. If the stock drops to your limit price, the exchange makes that trade. If not, you wait. It gives you a bit more control over how much you pay, but it also means that the trade might not happen right away. And now, what about selling? So it sort of works in the same way, but in reverse. So if you own a share of Nike and you want to sell it, you're hoping that there's a buyer willing to pay what you're asking for it. Again, you can place a market order to sell it at whatever the current price is, or a limit order to only sell it if the price reaches a certain level. And the stock exchange facilitates this transaction, making sure both sides, buyer and the seller, get what they're after. Here's the beauty of it all. Everything is happening in real time, often in just milliseconds. And that's why you kind of see stock prices constantly changing. Buyers and sellers are continuously negotiating prices, and when they agree, boom, a trade is made. It's a bit like an auction. Buyers offer to pay one price, sellers ask for another, and the exchange helps meet them in the middle. When there's more demand for a stock, the price goes up, and when people start selling off, the price drops. Again, supply and demand all over again. But the stock exchange isn't just a place for day traders or Wall Street pros. It's where anyone can invest in companies that they believe in. It's kind of like the heartbeat of capitalism, letting businesses raise money to grow while giving people the chance to own a piece of the action. So now I own a piece of Nike, or let's say I'm a bit owner of Coles or Woolies. How does that affect my everyday? And why is it worth understanding? Now here's how this connects to our everyday lives. Let's say you're driving down the road and you see a Coles and a Woolies. These are companies listed on the ASX, the Australian Securities Exchange. People like you might own shares in them through your super, and that means every time that someone shops there, you're indirectly supporting the value of these stocks. And when those companies do well, there's more sales and bigger profits, their stock price also tends to go up, which helps investors, including regular Aussies, see a boost in their savings or retirement accounts. Take the tech industry, for example. Australia has a growing tech sector with companies working on everything from fintech to clean energy innovations. When you invest in these companies, you're helping them to fund the future of these industries that will likely play a huge role in diversifying our economy beyond mining and agriculture. This also helps create jobs and boost national productivity. But it's just not all about tech, right? Let's think about infrastructure. Think transportation, telecommunications, and renewable energy. This is critical for a modern functioning economy. By investing in stocks of infrastructure companies, you're supporting large-scale projects that improve roads, bridges, airports, and even the electrical grid. These projects, in turn, make it easier for businesses to operate and for Australians to stay connected. And then let's talk about superannuation, because this is where stocks get even more personal for us Aussies. Your super fund, a lot of it is invested in the stock market, and the performance of these investments can have a big impact on how much money you'll have when you retire. When the ASX does well, your super grows. When there's a downturn, your retirement savings can take a hit. So even if you're not actively buying or selling shares, the stock market is still working in the background, and it's playing a big part in your financial future. Lastly, stocks also impact the broader economy. When share prices rise, companies feel confident to hire more staff and invest in new projects, and then expand. It boosts consumer confidence too. When people feel that their investments are doing well, they're more likely to spend, and which keeps money circulating through the economy. On the flip side, when the stock market stumbles, businesses might hold off on spending, which can slow down economic growth. So whether you're investing directly into the ASX, watching your super grow, or just going about your day, stocks are quietly playing a role in how our economy ticks. From companies that you interact with every day, to the retirement that we're all working towards, the stock market is woven into the fabric of life in Australia. And that's why understanding it, even just a little, can help you see the bigger picture of how money works in our world. To sum it up, we've unpacked the historical origin story of how the concept of stocks was formed, the democratization of access that this is now really affording to many of us, and also what stocks are and how they work. It's a massive part of how businesses generate growth, and also how the movement of the stock exchange and stock prices can really influence wider sentiment in people and the sentiment in the economy. This may all seem opaque and purely conceptual, but it's real money, real capital that's going up and down and affecting our lives. And by peeling back these seemingly opaque layers, we ultimately understand how stocks may impact and also enable a more positive financial future. So what does your financial future look like now? Thanks so much for listening. I really appreciate your time. If you've enjoyed the first few episodes and feel compelled to subscribe, that would really help our little channel. In the next episode, we'll talk about the concept of money and its role in the economics that inform your everyday life. You can find the Economics of Me podcast anywhere you listen to your podcasts.